I'm Ben Summers, and welcome to the Shadow Banker's Secrets podcast, based on the book I wrote by the same name. To help guide today's discussion, I've got my good friend and colleague, Stephan Piscano.
Thanks, Ben. I'm really excited to be with you, and I know we got a lot of things we're going to dive into, but me personally, I'm excited to talk about really the last market crash that we had there, 2008, 2009, because me personally, and I'm not speaking for you on this, I think we're seeing a lot of market indicators right now with all the chaos in the world in general and rapid inflation that these things are important. So I want to dive in with you at a higher level, really get into the specifics of what you did during the last market crash, things that I implemented myself as a real estate investor, and see what we can do to add value to people that are listening to the content today. So thank you for having me on, and let's dive in.
Appreciate that. Yeah, so I think 2008 requires a little bit of context, right? So why do you want to talk about something that happened, over a decade ago? And the answer to that question is really germane to how real estate people think about investing, how finance people think about investing, and of course, how the retail market thinks about investing. So when you think about finance, your mutual funds, your traditional assets, equities, whatnot, there's not a lot of thought given to the actual risk you're being exposed to. And because most retail financial advisors are doing the same thing, and they're investing in very similar types of assets with very similarly constructed portfolios, they all tend to kind of move together, which means that every time there's a market correction or a crisis, they all typically do very badly. And everybody's kind of okay with this because, well, everybody else did poorly too, right? And that's not necessary, right?
Just to piggyback on that, Ben, the people on Wall Street are okay with it. The people whose 401ks are in it are not okay with it.
That's a fair statement.
Yeah.
And then the real estate people, right, will typically latch on to that, right? They're like, oh, I've got real estate. It's not as risky. Yeah, it is. And it's potentially even worse because real estate people rely on pro formas. They all think they can predict the future. And not only do they think they can predict the future, they do it with an eternally optimistic view. The market's always going to appreciate, right? So you've got on the real estate side, people completely ignoring the past. And then on the finance side, people are largely ignoring the past. Most advisors who are even somewhat familiar with how to measure risk, they'll do it looking back for only a few years. Well, that's absolutely meaningless, right? And so
it's true, because you're in a market cycle there, right? Either way, up or down.
Yeah, you're just in the middle of it. It's a small piece of the entire pie that you're trying to evaluate, right? And so to meaningfully understand the quality of any investment, as I would say from a quantitative perspective, to meaningfully understand the risk-adjusted performance of any investment or portfolio, you have to look at its performance across a full market cycle, which I would argue begins around January 2007. Now, if you start looking at performance going back that far, you've encompassed what's arguably the greatest depression, not just recession, but depression the world has ever seen through 2008. And so the bad news is that we went through it. The good news is that we went through it because it provides an extraordinary amount of information in terms of what the downside can potentially look like. So if you want to make your own investment portfolio, your own investment strategy competitive on a merit basis, it needs to be constructed, engineered, designed, considerate of what 2008 looks like, and it should be designed to be robust against such market dynamics. So that's why I think it's very important to talk about 2008, not as a sort of an academic history lesson, but to inform how you invest going forward.
Well, and Ben, it's really critical for me to jump in here because it's not just to piggyback on what you said, it's not only that we want to look back and say, oh, okay, everybody was wrong in X, Y, Z. We want you to understand why people were wrong on Wall Street, in the stock market, the big boys, the Goldmans of the world. That's why Goldman, I remember it vividly, Warren Buffett had to do a $5 million bailout for Goldman for them to survive. Things of that nature. But we want you to be able to understand how you could actually succeed, because that's the biggest thing. I remember it vividly. March 9th, 2009 was the date that the Dow hit its low, and it was like 6,100. Now it's whatever it is, 40,000, whatever it may be. And I remember talking to one of my mentors in real estate, and they told me, the Dow, it's going to be at 2,000, 3,000, and of course that didn't happen. But people forget so quickly. We all have short-term memory loss. But people really thought it was doomsday. I mean, like you said, that was our Great Depression for our generation. And the fact that there's people that not only survived that, but really thrived during that period of time. And you got two people on this call in two different ways, but with the same philosophy. Number one, with you, because what you do provides it to the masses. Myself, as a real estate guy, I just did it for me. But I really want to get into the fundamentals of what made that possible, because it's so drastically different than what the rest of the world was doing at that time. So if I can take it before we get into specifics, I know everybody wants to hear the investment strategy specifics, right? That's why they're probably on this call. But can you talk to me? Because I remember what I was thinking 2008, 2009, and I was in my 20s, I was excited. But what were you thinking in 2008, 2009, when all this was taking place? Talk to me about your mental mindset and kind of where you were at.
I was watching CNBC and really disappointed that the Fed bailed everybody out, because I was poised to buy up everything for pennies on the dollar, and it never went down, right? That's probably the only time in my life I actually watched CNBC with any sort of regularity, just seeing what the Fed would do. I think the underlying principle that allowed me to navigate that dynamic is similar to what I'm prescribing today, which is no one can predict the future, right? Nassim Taleb has written in Inserto about this. The Black Swan is probably the most famous work he did from that collection. And the idea is that people grossly underestimate how often really bad things happen and their impact. In addition to that, the Black Swan itself is an event that can happen, or that will happen, that's never happened before and is entirely unpredictable. So as a quick aside, it's important to note that even looking at 2008 doesn't mean that you can plan against anything that can ever happen. It's a certainty that things even worse than 2008 will happen at some point in the future again. But
definitively,
but nobody's even buttressing themselves against another 2008. So it's kind of like the analogy of if you and your friend are in the woods being chased by a bear, you don't have to outrun the bear, you just have to outrun your friend, right? So I'm not saying it's good enough to not do well, but hell, if you are designing your strategy that's robust 2008, you're going to do astronomically better than everybody else. And again, the sort of underlying principle that I think allowed me to do better was I was not influenced by the pressure of the market. So at that time, I was exclusively in real estate. Not the case now, but at that time I was. And I knew that things were really inflated and that they couldn't go up forever. And that's when I started looking at other metrics and considerations that would contribute to the value of real estate over the long haul and what you might expect, right, beyond what was by perceived, to look beyond what was considered by many to be a bubble at that time. So what the real estate we're doing then is the same thing they're doing now and always have done, which is I'm going to predict the future. Except now the market was euphoric. So now the market wasn't just going to appreciate in perpetuity without ever experiencing a decline. It was going to grow exponentially in perpetuity without ever experiencing. Right,
Ben, I got to tell you, I bought my first house when I was 20 years old during the the start of that bubble. And I remember the real estate agent told me, because I told him, I'm like, because I was 20 years old, I couldn't afford the house. And he told me, he's like, well, don't worry about it because you're going to be getting $10,000 a month in equity. Like, people said that. People
Yeah, I remember.
Yeah, I mean, it's just insane looking back on it. But like you said, the same stuff is repeating itself now. It's just nobody realizes it now like nobody realized it back then.
That's right. And if you look at the data today, so at that time, what I used to inform my perspective on property value, particularly in the residential market, was the relationship between owner equivalent rent and the housing price index, which is basically government tracked data that measures the value of homes versus the market rental income for homes. And the income was stable, had always been stable, didn't show any steep deviations, but the comparable sales-based valuations, the HPI, did. It was growing exponentially. So at that time, what I was doing was looking backwards in history, 100 years, to inform my decision about what to do going forward. So what I was doing at that time, I was not a finance guy yet. I didn't understand quantitative risk analytics, but I knew epistemology 101, and I knew that what we know today is a function of what we've experienced in the past. The only thing we have to go on for making decisions about the future is our past experience. Where else are you going to look? So what I did intuitively was look back in time, effectively 80 to 100 years, and saw that rental income was very stable forever as far as the data went back. The income-based valuations, the comparable sales-based valuations had taken off exponentially. That was a new and novel thing, as Nassim Taleb might say, non-Lindy. So I relied on the more stable, longer metric, which was income. And so what I'm prescribing today is the same methodology I used then. Instead of looking at what's happening right now, instead of looking at what's happened over the past 10 years, which has been anomalous since the Fed injected QE, right, into the market, and it's created a completely unique dynamic with all the liquidity it's flooded into the system. Look back for many decades, or as many as you can, and use that information to inform how you move, how you make decisions going forward. That does not require a PhD in mathematics. That just requires
the common sense.
That just requires looking backwards in time in lieu of A, pretending you can predict the future, or B, looking at a very small segment of history which is corrupted by unique dynamics, particularly the Fed. Right?
Well, that's the thing, man. I mean, you have the desire to actually put that time in, and that's what's like all of this stuff. And anybody will tell you with anything that you do, I don't care if you're an Olympic swimmer, if you're a trader on Wall Street at Goldman Sachs, if you're a seasoned real estate investor who's bought hundreds of homes, it starts with a light bulb. You know, it starts with that moment where you go, oh, wow, this makes sense. And then you continue to educate yourself. And to me, that's the purpose of what we're doing today, is to be that light bulb for people, to get them intrigued enough to have, you know, the phrase that you always use, intellectual curiosity, to explore it more, to go, okay. And then once you get to that level, there's a comfort there. You know, I mean, and we're both passionate about this, but to me, this is number one. Like when we're going into a market cycle like we may or may not be going into now, I'm not predicting a crash, but I'm predicting rapid fluctuation up and down with what's going on in the world. And it to me, it breaks my heart that people are actually scared of this, because I'm not whatsoever. Not because I'm so smart, but it's because once you have that knowledge base, once you have that foundation of what's happened over decades and decades, you kind of have an educated guess on where it's going to go, and you can protect yourself. And whether you make millions or not, who knows, but at least you can capitalize to some extent, you can protect yourself. So Let's talk a little bit about specifics.
Sure.
And you kind of touched on it already. You based your strategy back then on cash flow and all that. And I can attest that too on the real estate side. I wrote an article for LinkedIn back in 2016 called "If the Market Crashes, I'm Happy." And the point of that article was, if you're basing your strategy on a cash-on-cash return, if the market crashes and properties are now worth half of what they were, it's actually a good thing because rental revenue largely remains the same, so your cash-on-cash return actually goes up. Talk to me about how you started there and then how you evolved to where you're at now, because I know we're going to dive in a little bit onto how you're kind of, to some extent, asset class agnostic, and you really just go with whatever works. But let's start there. Talk to me about, in specifics, the strategy you used during 2008, 2009 that worked so well.
So what you just expressed is a common theme that most real estate investors, particularly multifamily investors, proffer. I would say it's necessary to build on that one step further, because especially if you're working with other people's money, right? If you're working with only your own money and there's no horizon per se, or there's no short-term horizon, then the penalty for a contracted market, loss and value of the property, is much less stiff, right? It's a very different game when you're managing, say, a fund, and you've got other people's money, and it may have a lockup, and you may have to liquidate that fund at a time that the market's at a bottom. It takes a lot of monthly rental checks to offset a 20% drop in a $5 million property, right? So I would say it's not sufficient, and for me it wasn't. So I wasn't just relying on the cash flow in a vacuum. I was looking at the cash flow as the primary metric for valuing the property, to protect myself from the property losing value. So what I heard you say, and what I hear a lot of commercial real estate people say, is that they don't care about the value of the property, they just care about the income. Well, I cared about both, and I used the income as a means to value it. So what I would do is I said, all right, if you look back 50, 100 years, what was the relationship between the income and the value, the cap rate, right? Or in the residential side, gross rent multiplier. What was the typical cap rate that the market would usually support? And what you saw post-2000 is that those cap rates became very highly compressed relative to what history had shown us for a very, very, very long time. If you're a betting man, you're going to bet on what has been the more stable dynamic as opposed to what appears to be very transient. This obviously was transient because the comparable sales valuations, the cap rates were compressing exponentially. So that's a huge difference. I do care about the value of the property. I did. And I knew that because I tried, I couldn't buy properties at a sufficient discount to protect myself from the correction that I thought would probably happen, right? So instead of following the guidance of every real estate agent in the market and just paying what the market said it was worth, again, based upon comparable sales, I said, historically, in this market, properties have traded at, say, 16x the annual NOI, net operating income. 16 times, it's an arbitrary number. Say it's 16 times the annual, right? And that would be the value that I would place on the property, regardless of what any appraiser said, but I didn't say, right? And so if I couldn't buy it there, I couldn't buy properties at that point. That's what pushed me into lending. I could lend there, right? So now, instead of being the buyer, I would say, okay, I can't buy this property, but you want to buy it? Fine, you buy it. I'll lend you this much money, right?
And then your LTV that you had on it got you to that 16x in the hypothetical scenario, to where you had the same ROI either way.
I had the same basis.
Same basis.
And the ROI was better, right? Because at that time, especially 2009, like even up to 2008, hard money lenders are still kind of difficult to find, right? And then
the real ones anyway.
Yeah, and then 2009, like there was no liquidity anywhere because all these hard money lenders were even running their business poorly. They were over levered. They were drinking in the same Kool-Aid, right, and getting irresponsible chasing deal flow.
I personally know dozens of them that went bankrupt in that period because of what you're talking about.
Yeah, because they were relying on comparable sales-based valuations, right? They might be lending at a relatively low LTV compared to a commercial retail bank, but it was still high relative to where the market was going to correct to, right? So,
Man,
go ahead.
I know I love where you're going. Just quick piggyback. What we're talking about, guys, this isn't a history lesson. This is modern day, because it's one thing, like I just can't double down on this enough because it actually almost makes me angry. Like we talk about this stuff, right, and we're laughing about it, and it's like so obvious now. It's obvious, now too, what's happening in 2022. Am I right? Like all this stuff you saw better than me. I saw it a little bit too in 2008. Nobody saw it. The same thing in different ways is happening right now. That's why this is relevant. This isn't just to like pat ourselves on the back about how cool we were in 2008. This is relevant to what's happening today. Am I correct in saying that?
It is. So if you look at the relationship between the housing price index and owner equivalent rent, that relationship is worse today than it was in 2005, 2006. Now, the drivers are different. So the reason that valuations ran away from income in 2005 is because the Fed injected liquidity that found its way into the mortgage market, and mortgage lenders were just running rampant and giving money away specifically to the real estate industry. Today, just like in 2000, the Fed pumped money into real estate to offset the dot-com bubble. Since 2010, 2009, especially 2012, when QE really got kicked off, the Fed has injected money everywhere to offset the housing bubble bursting. So now what you have, instead of people blowing out, say, an asset class like real estate, you've got the Fed blowing out the dollar. So it's not just money in real estate that's driving this separation between income and value. It's the fact that there's just trillions of dollars floating around the world, and it's got nowhere to go. That money reaches the investing class first. So that's why you've seen the S&P run up for over a decade with completely ignoring fundamentals. And it's also now why I kind of call real estate a quasi-traditional asset class, because the money has found its way into real estate too, and it's just run up for the past decade plus in the same way.
As a real estate guy, I can tell you before right now in our country's history, we've never seen a market cycle appreciation longer than 7 years, to my research anyway, in the 250 years, whatever it is, we've been a country, right? Now we're going on 11 years, 12 years of appreciation. So that alone is scary. When you talk about the inflation tech and things of that nature, that makes it more concerning. But again, as I keep kind of coming back to, and it just, again, it makes me upset that everybody doesn't feel this way. Because to me, it's so simple. To you, it's more simple than it is to me. I just listen to what you say. Kind of try to implement it. But let me ask you this, because we're talking a lot about real estate, and I'm obviously kind of partial to real estate because that's my background. But you've really become asset class agnostic to some extent, like I said earlier. What was it that initially made you kind of make that shift? Because you started in real estate, you started with the private money lending to some extent. When did you shift? What made you shift? And how is that relevant to what's happening today in the markets?
So the reason I shifted out of real estate into finance was what I perceived to be, and I think actually was, a function of necessity. Again, I didn't have enough friends and family with money to raise enough money to scale my asset-based lending business, my asset-based lending fund where I wanted to go. And so I needed, as I perceived it, to dive into hardcore finance to develop that skill, that wherewithal. And that path led me from real estate investing to real estate lending fund to now running an investment bank that capitalizes asset managers regardless of their asset class insofar as their performance is better than what's otherwise available through traditional markets. So the very short answer is that evolution was a function of me simply trying to raise money for my own strategy. And what I learned on that path is you can do much better than just running one fund, right? There are better paths there. But before we leave,
more protection too, right? I mean, more diversity and
more scalability, right? So instead of being concerned with saturating one strategy now, I've got many different strategies and more all the time that allow for allocation without compromising performance, without having to invest in one large monolithic strategy that has lost alpha like a long time ago. So,
well, and I love the simplicity, the way that you said it to me once, Ben, which is this, that you can kind of go whatever's performing best, right? I mean, you can put it wherever you need to put it to make sure that you hit those returns. And I mean, that's an opportunity for me to say too, we're talking about the S&P, the ups and downs there. I've looked at your track record for going on about 15 years now. You've never been below 20%.
That's right. And a lot of that has got to do with the inefficiencies in the private credit markets, because that's where I've been primarily. But before we sort of go too far off this trail, I want to harken back to this idea that you cannot predict the future. That is a fool's errand. And the point of this discussion is to drive home the point that how do you make decisions? How do you make decisions in this chaotic environment? And again, everybody wants to predict the future. Fucking everybody wants to say, oh, I think this is going to happen. I want this going to happen. I'm going to try this. And what I'm telling you is,
such a waste of time.
No. Look at what's happened in the past. See, what is the worst case scenario that we have experienced to date? And just make plans around the expectation that worst case scenario is going to happen again and probably a little worse.
And then if it doesn't, you're good either way, but you're protected. That's the comfort I'm talking about.
If you take care of the downside, the upside will take care of itself. If you take care of the downside, the upside will take care of itself. Period, full stop. So that is the point, right? So even today, so what's going to happen? Is it going to be like rampant hyperinflation? Or are we going to have like steep deflation because the fundamentals aren't there in the middle class? The middle class is being eaten away. What's going to happen? And I'm telling you, stop trying to predict it, right? Look back at what...
Focus on what you know, not what you don't know, right? I mean...
Right. If you have designed your strategy and positioned yourself against a 2008, there's a chance you might get hit going forward. But you'll be really well positioned relative to everybody else. Right? And you'll do well compared to everybody else.
That's why, I mean, honestly, and we're about the same age, man. I mean, that's why I look at it. What a gift it is that we kind of got to get into things, during that crash, because it's been, for me anyway, it's been an incredible lesson. And it's been the foundation that you can always come back to. Rising tide floats all boats. The last 7-8 years, you buy something, it goes up. Okay, great. But you didn't do anything. You didn't learn anything. The fact that we kind of got that right out of the gate, got to have that learning experience. I mean, for me, and I obviously we're talking about for you more than me, it's shaped the foundation that we can feel protected going forward, regardless of what happens.
That's right. And that I want to address another point that I can already hear people objecting to, right? They're like, well, now people in the last year have woken up that, inflation is a thing, right?
I know. It pisses me off.
And so I can hear somebody right now saying like, oh, you're prepared against 2008. That was deflationary. You weren't prepared for inflation. Well, actually I was, because of the way these private credit structures were engineered to capture an equity piece. But the point I want to make is that the Austrian economists, the people who really know how money works, have been screaming from the rooftops, especially since 1971 when Nixon closed the gold window. I don't know how many people remember, but Volcker had to hike the Fed funds rate to over 20% in the early 80s to offset rampant inflation in the 70s. And it's been a house of cards ever since that time. Rampant inflation has been an ever looming risk for 50 fucking years. Just because you discovered it today doesn't mean it's a novel issue, right? Like,
anyhow.
Yeah.
It's upsetting. I mean, you do it at a higher. I've done literally 200 webinars about inflation, rapid inflation. And the fact that now every time I'm talking to somebody in a grocery store, they're saying, "Oh yeah, gas is way up. That's that inflation." It's just so silly. But you can protect yourself. You can capitalize on this.
You can. And the point I want to really make is that, because people have selective hearing, is that preparing against a 2008 does not mean ignoring the inflation elephant in the room. I've subscribed to Austrian economics for a very long time, and when I was designing my strategy at that time, part of my motivation for being in real estate alone was the consideration that great inflation is an ever-present risk. So you have to position yourself against both inflation and deflation simultaneously. Today's dynamics are no different, even though more people are aware of it now than they were then. Yeah.
Well, and Ben, it's your podcast. I'm not telling you what to do, but if there's a way to do it, put your slide up with your performance right here for 2007 to 2022. Because if you hadn't prepared, that's great. You earned 40% in 2009 when the S&P was down 40%, whatever it was. But if you hadn't prepared for both sides of the coin, you would have had a down year. You've never had a down year.
Right.
Through the market crash, through the recovery, through the stability, you've never had a down year. So obviously you prepared for the whole thing.
Right. And this is where traditional finance people, regardless of how sophisticated they are siloed and aren't aware of what's possible because they are conditioned to think in terms of publicly traded equities. And I will be the first one to tell you, because we work with some of the most sophisticated quants in the world, with some of the most sophisticated and quickest algorithms you're going to find. And the best I've ever seen from an equities trading perspective, trading stocks, is the conservation of risk and return. So as the retail financial advisor would say, if you want to get higher returns, you got to take on more risk, right? That's just the rule. And that is true in the context of equities and stocks. And you can prove it mathematically. And what that looks like in math is that the expected return, at best, is approximately equal to the maximum drawdown, which is how much you would lose in a down cycle, which is approximately equal to the standard deviation, which is how much it goes up and down, right? So it doesn't matter how sophisticated you are, how good your algorithm is, that is true. Conservation of risk return, because the equities markets are efficient, is a fact of life. For private markets, that does not hold, because private markets are inefficient. They are where arbitrage opportunities exist. Arbitrage is where the price in one market is different from the price of another market simply because of the dynamics of that market, not because of the thing, right? So in real estate, for example, there are unique properties that people don't know about. There are unique circumstances that people don't know about. Inefficiencies in cash flow. For example, hard money lenders don't get the same capitalization that retail banks do for their conforming loans, right? So information flow, inefficiencies there. Inefficiencies in capital flows create arbitrage opportunities where you can greatly separate risk and return. But traditional finance people don't think in those terms because they're looking at the S&P. And I'll give it to them. Looking at equities, you're right. Risk and return are conserved.
Ben, you said something there that was interesting to me. When you talk about, and I know you have a background in mathematics, does every decision, and I honestly don't know the answer to this, does every decision that you make from an investment standpoint, do you always put it back to the fundamental mathematics of it?
Yes.
You always, okay.
Yes, that's a non-negotiable. Yeah, understood.
So that's why.
So you can use the story, you can use the narrative as context, right? To point you in a given direction. But to make a final decision, to evaluate accurately, objectively where you are, the mathematics tells you. And I don't mean to present that evaluating investments is an exclusive skill set. I mean, there are some skills that are required in mathematics to accurately measure risk-adjusted performance, But you can use one simple heuristic that anybody can, even if you need an abacus to count to 6, which is if you look back in time to say 2008, look at whatever investment or portfolio you're currently considering and say, how did it perform then? If it did well then and it's done well since then it's good, right? It gets a green box, it gets a check, whatever you want to, right?
That's Ben, I have to tell you, that's the number one thing I tell, because, again, I've known you for, 7-8 years now. We're working together on different projects, all that. I've referred people, all that. When people ask me about the process and about partnering with you or whatever it is and utilizing your strategies that have been so successful, the number one thing I tell them is, look, I made millions of dollars 2008 to 2012, me personally. But I don't know what this guy knows. And what I love about him is he's got a track record, good markets, down markets, medium markets, the whole thing across the board. And it's one thing to have a knowledge base of what's coming. It's one thing to have gut instinct. That's me. But what you want to do is you want to partner and associate yourself with people that have a track record. That's you. You have the knowledge base, you have the common sense, and most importantly to me personally and the people that I've, referred to you, and what you do is the track record that you have. That gives me comfort knowing that you've seen this before. This isn't new to you. This is another rodeo. This is the same old thing, but a different package. Am I crazy to say that?
No, I certainly appreciate that. But to be honest, that wasn't my motivation for learning this skill set.
I know. That's what makes me love you more, by the way. But anyway.
The motivation, actually, was to communicate my real estate strategy to the finance people who didn't like me and respect me, right? So yeah. I knew they had their own way of doing things, their own language, their own sets of expertise, and I felt the onus was on me to meet them where they were. So I was like, well, telling a story about real estate is not going to resonate with them, but theoretically, quantitative risk analytics is the means by which real finance people evaluate investments. So I need to communicate what I did quantitatively so you can take my strategy, my portfolio, and compare it to theirs with the same language. They still dismissed it because what I found is 99% of finance people don't understand quantitative risk analytics and quantitative finance, right? They just don't.
I'm blown away by that. Anyway, go ahead.
Yep. But the point was mathematics is a universal language. And again, what really is like, a lot of finance people even believe that, you can only use quantitative methods to evaluate equities. They don't apply to alternatives. Dude, you can evaluate the quality of your wine collection as an investment with math, right? Math is just a language, and the same principles apply to everything if you know how to use it. The problem is an MBA or a CFA does not impart the math chops required for people to use it effectively, and that's the problem. So in the domain of finance, if you've got a CFA, that is the top tier credential, right? MBA, maybe second to CFA, but that's it. And you learn a lot of stuff. And I'll be the first one to tell you that the CFA is an extremely difficult certification to achieve. I'm not disparaging it at all, but I am saying that you do not acquire the necessary math chops to properly evaluate assets and portfolios.
I'm disparaging it.
Okay, fair enough. Fair enough. So anyway, the point of that exercise was simply to be able to communicate what I did to the finance world. And an extension of that point is quantitative methods can be used to demonstrate or illustrate or communicate the quality of any asset or portfolio, regardless of asset class, regardless of liquidity, compare everything in apples to apples terms. So yes, Steph, I appreciate that the track record
it's huge.
It's compelling. And again, the track record alone is the track record alone. But it's
not compelling, Ben. It's mandatory to me. Like that's the thing. I keep telling you that. I think you're too humble or so. I don't think you realize how rare that is. Maybe you do. I don't know. But I mean, it's shocking to me.
Well,
and I'll just give you a little more kudos. not only am I an investor, for those who don't know, and I know some people are going to see this or in my network and know, but I mean, I own the largest real estate group on LinkedIn. We got 2.2 million members. I've done hundreds of marketing campaigns, forget me and my stuff, promoting things, auction.com, Quicken Loans, different investment strategies, funds. I can honestly, truthfully say, I have never seen anybody with a consistent track record like yours that's in. And that's why you're the, first person I've ever wanted to come on a podcast with. First time ever. It's amazing. It really is. And people need to know about this. People need to understand this so they can be prepared. I'm passionate about it. When I hear you talk about the banks, when I hear you talk about what happened in the last crash, it makes me angry. It like physically makes me angry. People need to hear what you've done. They need to understand it, and they need to implement it.
I appreciate that. Yeah, and it's not, I mean, it takes some effort, but it's not impossible. It's just overcoming peer pressure, for lack of a better term. So what makes me unique is quite simply the fact that I'm willing to bridge the gap between all asset classes. Initially it was real estate, right? Bridge the gap, and then use what has been established as the means of evaluating the quality of investments, which is risk analytics, risk-adjusted performance metrics, which found its way into academia in the mid-20th century, right? With alpha, beta, the Sharpe ratio, which is a second order, right? You need to account for all four statistical moments, but regardless, these aren't things I invented. I just synthesized them, right? So I picked up all right, here is the gold standard for evaluating the quality of an investment. All right, let's put this in the pocket. All right, here are the benefits of private markets and asset classes. All right, put that in the pocket. Here are the benefits of traditional finance. Put that in the pocket. And when you take the best of all worlds and you put it into one package, it yields astronomical results. And it's simply because other people don't do that.
It's shocking that they don't. It's shocking. Well, that's what I love about it, though, is that, like, if you told me that you were Albert Einstein and you were saying just a bunch of things that I couldn't even remotely comprehend, which honestly you're pretty close to that, but anyway. But I mean, then it wouldn't have as much meaning. What I love about what you do is that it can compute to common sense for normal people. I mean, you have to have a working brain and you have to want to seek that intellectual curiosity that we always talk about. But once you do that, you can comprehend it.
What I've tried to do is be aware and considerate of the fact that people have different skills, resources, and interests, right? So I'm not a relationship guy. I'm not the guy who's going to just go out and play golf every weekend and just, have a huge network that I, stay in contact with and rigorously maintain. That's not who I am. Other people do that, and that's their thing, right? Just like other people aren't going to sit behind, a spreadsheet or sit with pen and paper and write out mathematical expressions. So what I tried to do was to say, all right, this is the body of knowledge that needs to be taken on board, needs to be utilized, right? And now, given this is all the stuff that's required, where are your interest, resources, and expertise, and what sort of facet of all this can you fit in to carve out your own piece while collaborating with others who are while collaborating with others who are while you're collaborating with others who complement what you're doing and may bridge some of your shortcomings. So in the book, The Shadow Banker's Secrets, it was intended to be comprehensive, but it's not. But it's not. It's not necessary for everyone to fully embrace and understand every component. The idea is to take away the pieces that resonate with you, and then collaborate with others. Could even be me, right? To complete the puzzle.
Man, I think you just touched on something that's relevant that we haven't talked a lot about here. But I mean, having talked with a lot of people that have read your book, I mean, the common thing I get, I hope it's not offensive to say, but I mean, the common thing I get is, wow, I really love the book. It was really high level. It was obvious this is brilliant stuff, but I'm just kind of missing it from a point. That's kind of the point of what we're doing with this conversation today and all the conversations we have, right? Is to kind of take the book, I don't want to say dumb it down, but take the book and simplify it a little bit from a broad standpoint. So at least, I mean, obviously the best thing is if somebody's intrigued, they want to learn how to do this, schedule a call with you or investigate it further. But if somebody doesn't want to take that step, at least if they watch one of your podcasts or whatever it is, they'll learn something that'll help them, right?
Yeah, so my intent with this discussion and this podcast is to take the topics that are efficiently written for the purpose of a book and covering them conversationally, right? It shouldn't be a surprise, but sometimes it is, how I'll feel that I wrote something really clearly and it just doesn't resonate. But then when you start talking about the topic, when you have a conversation, then all of a sudden the ideas begin to crystallize. So that's the purpose of these types of discussions, is to, again, take copy, or that's the purpose of these discussions, to take material that's written in a book and to present it in a format that may be more palatable.
No, well, and that's the thing. I mean, you know, you spent, how many years, you spent years writing the book, didn't you?
Yeah, and I'm probably not the only author to say this, but editing and proofreading probably took longer than writing the drafts. And
so, I mean, we're talking a lot about what you did in 2008, 2009 during the last crash and what I did and what we both saw. But, I mean, obviously, that's all great. Everybody wants to know what's going to happen in the future. And we've talked a lot about you can't predict what's going to happen in the future, but the beauty of your strategy that you developed, you're not reliant on predictions of appreciation in the real estate market or, you know, the stock market, whatever it may be, the bubbles that go up and down, up and down. You've got a mathematical formula that can be the basis to evaluate any strategy in any asset class. So if I'm listening to this today and I'm saying to myself, like I am personally, I think there's going to be fluctuation. I think there's going to be ups and downs. What do I need to do? What would you tell that person? How can we allocate what you learned from the last market crash, 2008, to 2022? What would you tell me?
So if you're an asset manager, it's a matter of taking stock of where you are right now, measuring the value, the quality, the risk-adjusted performance of your current strategy, your current assets, the assets you potentially have access to, and then designing a strategy that is robust to the downside potential that we saw in 2008, while simultaneously being robust against incredible potential inflation. If you're not an asset manager, if you're a passive investor, the first thing I would ask anyone that I would trust to manage my money is, how do you define risk? What is risk? And I think you'll find, shockingly, that almost no one can answer that question. They will tell you things that contribute to risk. They'll give you stories. Again, they'll talk about contributing factors, but that's not what risk is. And if someone can't define risk, how in God's name can they manage it? And if they can't manage risk, if they can't manage the downside, they've just told you they can't manage your portfolio. So again, we're not a retail advisor. We're not looking to manage retail client money. But this is extremely valuable guidance for those looking for others who are. Risk is the probability of loss weighted by the potential degree of that loss. It's not a relationship. It's not a feeling. It's not a story. It's a number. And interestingly enough, people have no problem thinking about expected return as a number. That's a percentage. Everybody gets that. People have no problem thinking about liquidity as a number. I need my money back in 6 months, 1 year. But when it comes to risk, the conversation always immediately devolves into storytelling, right? And the irony is there's a precedent for this. A casino Their business is managed 100% around the probabilities associated with each game. The only difference between investing and gambling is that in gambling, the probability of loss exceeds the probability of gain. With investing, the probability of gain should greatly exceed the probability of loss, but it's still a number, just like the casino. And you're fooling yourself if you think the big wirehouses don't know what those numbers are.
Well, and that's the thing, Ben. I know we'll hopefully talk about that more in the future here, but when you're dealing with high fluctuation, when you're dealing with shifts, you don't want to guess. You don't want to be at a casino. Whether that's the stock market casino or a regular casino, you want to have at least some sense of certainty, and nothing's ever guaranteed. I mean, literally, I can tell you from experience, a T. Rowe Price money market account that gets a 0.5% return annually is not technically guaranteed, but you want to have a foundation that you can come from. You want mathematics to be able to cross-reference and check everything you do as an investor, and that's what I'm excited about, what you do. I really appreciate us being able to go through it today, and I feel like we can cover it in more detail, but I do agree with you. That's probably a full conversation in itself.
I agree, and I look forward to having it.